Alright, so the next thing I'm going to do is I'm going to go over market technique volume studies. Now, I'm not going in sequence because, like, I just finished the first study, and you know what a hell, it was pretty exhausting. So, I'm going to jump around and just do what I feel like doing, and then, maybe then do the point figure studies and stuff like that. But it's much easier to like jump from like some study to then just reading, then to study, then to do study after study after study. So anyway, market technique volume studies. As a preliminary to further studies, we sum up in following general observations what we have learned in preceding sections. Supply and demand. Always keep these facts in mind. Prices move up and down according to the law of supply and demand. This is true of the stock market as a whole and every individual stock. It is true of bonds and commodities. And Forex, by the way. When demand exceeds price, rises. Alright, we all already know all this. When supply and demand are equally balanced, the market stands still. It fluctuates within a narrow range. Traders, by the way, this narrow range thing is really important. I'll go to it in other studies, but if you've been following along, you know how important that is. Traders and investors are influenced by buy and sell as a result of news, earnings, etc., etc. And whatever the cause of the buying and selling, the result is added pressure in the market. Alright. One's ability to judge comparative being very important, support and pressure, supply and demand is the measure of one's success in trading and investing. Some of the supply and demand may be artificial, a result of manipulation. Okay. Alright, so nothing really of exceptional here. Next is technical position. A market is said to be in a weak technical position on the bull side when the buying power has been exhausted. This is important. How do you know a market has been is exhausted? Basically, what this is saying is weakness equals climax. Okay? So, if a market rises on the top of a swing, and on the top of a swing it bumps up, it accelerates, it's not in a strong technical position, it's in a weak technical position. Alright, so you're always keep in mind, you want to look for exhaustion. Okay? Either in a small or a large way. Small way on top of a swing, large way on top of a trend. Alright? Or bottom of a swing or bottom of a trend. A campaign of distribution exhausts buying power in a large way because much of the fluctuating supply of stock is then in the hands of the public. Sponsors of large operators have sold. Those of the public who still hold these stocks are potentially bearish factors because having bought, they must sooner or later sell, and their selling will bring pressure upon the market. Alright, so let's just go back for a second. This is very important to say. A weak technical position on the bull side is when the buying power has been exhausted. You want to be able to find when the buying power has been exhausted. As one of the things you want to look on your chart. Meaning you want to see exhaustion in terms of price and volume. Typically it's large spread and big volume on top of a trend or a rally or whatever. Okay? And even on a pullback, by the way, when it's pulling back to like the 50% level or whatever retracement, and you see it accelerates and it has big volume, it's not in a strong technical position, it's in a weak technical position. And you won't be able to see this in the indicator. The indicator will actually turn and show that that it's good, but it's not. It's not good. It's bad. Alright, or shouldn't really say good or bad. It's bearish. It's in a weak technical positions. This was the case in 1929. The whole market became saturated by stocks held by those who are looking for profit. By the way, I think this is the current case today also. everybody's in stocks. Buying power, or I think this was also the case with crypto around Thanksgiving of last year. They were all stuck in Bitcoin because anyway, buying power was exhausted. All right. When those holders started to sell, they found little market for their shares. As prices of stocks declined, more and more were obliged to sell or were scared into selling. So the thing is, you have to identify exhaustion, and you won't really know exhaustion until additional attempts are made. Those additional attempts, the lack of volume and the lack of pressure, the lack of volume and pressure will identify that the prior attempt was exhaustion. Alright, the load of stocks in the market is increased, margins were blah blah blah, every seller helped force price down. The effect of this was cumulative increased pressure bore down the market, which was totally unable to absorb the gigantic offerings. The result was a collapse and a panic, and etc. etc. A weak technical position occurs in proportionally smaller way when buying power is exhausted for the time being. For the time being. For the time being, it could be at the bottom or top of a swing, as after intermediate or minor upswing. There you go. Yeah, I knew it. Anyway, because that's what he's been talking about in his studies. So, a weak technical position in a smaller way is on top or bottom of a swing. It could be on a pullback as well. A common form of this condition may be seen in examples previously referred to as overbought position and buying climaxes. Yeah. A strong technical position develops when liquidation has run its course. When liquidation has run its course. Okay? We'll go into that in a minute. This sort of thing happens again despite the present day. Alright, whatever. Anyway, he says liquidation has run its course. What does that mean? On a pullback, after a rally, you want to see a pullback, you want to see liquidation run its course, there's going to be a minor climax. Liquidation ran its course. On a pullback, you have liquidation running its course or the retracement running its course. On top of rallies, bottom of rallies, and then on top of trends, and such a condition usually prevails at the end of a big decline, a panic, or depression, sometimes finishing up stages of a decline, weak holdings being sold to strong buyers. It requires many months. The public or such has learned to operate on the bear side, is generally short at the bottom, just as predominantly long at the top, because the public operates with its ears and emotions instead of with its thinking process. This is for many reasons, because the public is purposely misguided. Just take a look at the literature out there, literally telling you to draw two lines, and based on a candle and its position amongst a line, or kindergarten shapes, to take a position. This is ridiculous. You think that any business can run on shapes? Like, it's really, if you put all that stuff away and ask somebody, without them knowing about all this stuff, they would really be thinking twice. So, and that's the type of literature that's out there. Okay. These amateur shorts are potentially bullish factors because they must eventually cover what they have sold short. The same conditions, though on a proportionally smaller scale, are prevailing when supply is exhausted on an intermediate or minor downswing. Minor downswing is a pullback or a swing up or swing down. It doesn't need to be on top of or bottom of a trend. It is then that the market develops the characteristic of oversold position and selling climax, as already discussed. So on a smaller scale, on a pullback, you want to look for a climax. That climax means that it is in an oversold position. Oversold and overbought position, as you can see from the immediately preceding paragraph, these conditions are corollaries, respectively, of a strong and weak technical position. Basically, they're kind of like the same thing. In other words, an oversold position is substantially the same thing as a strong technical position. Oversold equals strong technical position. Now, when it's said oversold, do not confuse this with what people know about oversold, which is below 30 and above 70 on any indicator. Like, that is not oversold. Oversold here, or overbought, is when there is a transfer of inventory and liquidation has run its course, or there's a transfer of inventory into the hands of the public. Alright? Public. And these things are identified by volume. They are not identified by a decline in price alone. Okay, so this is a key characteristic of oversold and overbought positions. Basically, you have to ask yourself, who owns the inventory? Who owns the inventory? That is going to tell you if it's in a strong or weak technical position. Okay, it's not based on under 20, above 80, stuff like that. No precise definition can be given whereby we may determine the exact point at which the market or stock is definitely oversold or overbought. This must be determined as explained in previous references to these phenomena. The following definition will serve our purpose. Oversold. What is oversold? Now put the indicators behind you, 30, 20, 20, 80, whatever. We consider a market or a stock as having developed an oversold condition when, as a result of its failure to experience normal corrective rallies or adequate resting spells during a downswing, or because of the too rapid acceleration of a reaction or a decline, the price reaches a position where it becomes highly sensitive to short covering and to general withdrawal of experienced sellers. Basically, it's moved too far too fast. Alright, but in my opinion, it would be sensitive to short covering, and there are indications. You'd see shortening of the thrust, you'd see clustered closes, you'd see a lack of upside or downside progress in terms of obviously shortening the thrust, effort reward, or you'd see climaxes or whatever. So those behaviors need to be there when after market has moved too far too fast, whether it's a swing up or a swing down or a pullback up, pullback down. Alright, and the same thing with overbought positions. Too rapid acceleration of rally or an advance without intervening corrective reactions or resting spells. So meaning it doesn't pull back. It just rallies and rallies and rallies without pulling back. But as it rallies, there needs to be certain behavior up there which verify that this is an overbought condition and not a momentum stock that's on a tear. Okay. Rallies and reactions as indicators. When a stock rises 10 points, a normal reaction is halfway back, 50% retracement. This does not mean that the stock must react 5 points after an advance of 10. It means that the extent of this reaction after rally or an advance is checked. should be regarded as one of the indications of its technical strength or weakness. So you always want to take a look at how much the retracement is. Is it a full retracement? Is it a 50% retracement? What kind of retracement is it? So he's using that as a measure of judging supply versus demand and vice versa in terms of, how much of a pullback or how much of a retracement is there. Strength is indicated by a smaller than halfway. Weakness is indicated by greater than halfway. So if it retraces 40%, it's stronger than a retracement of 68%. That is to say, 10-point rally normally would be 5 points down, and if it's only 4 points down, it's strong. If it's 7 points down, it's weaker. These indications should be closely studied. The tape is full of them every hour of the session, and the charts reveal them from day to day, week to week, month to month. So closely study them, and I'll give you an example right here. Alright, let's go to the market rallied up here. It overshot, did not correct, then it went down, it pulled back, and it went down. Look at these retracements and how much they pulled back. This pulled back around 50%. This pulled back around 50%. So these are normal corrections. These are very, very normal. Okay. It goes down, comes back about 50%. These are normal corrections. Let me find an abnormal correction. This is interesting because it's not correction, it's a shakeout, so I can't use that example. But in general, you see very clear, normal. Where's my line? There you go. You have about 50%, or you have about 50. This is actually weak. It didn't even come back up. So this is weakness because the retracement is less than 50%. This retracement should be about 50%. This retracement should be about 50% maybe, like right there. This is weakness right here. This is weakness right there. That's definitely weakness. Why? It's less than 50%. And selling is coming from a nice high. It's not at the bottom. Then I'd be a little worried. This is okay. This is a little strange because you see from low to low the progress that's made, but from low to low there's not a lot of progress here. That's telling you something. You want the break to be, to have follow through so it can pull back. Let's see, this is not that good. It's only 1 bar below the prior low. It's probably why it turned very close to that area. This is okay. You have more. You see this low, you have multiple bars below it, and then it pulls back and tests. This is a nice break. It's a little oversold though. This one's not that good because the high to high is very sluggish. Anyway, you get the idea. What the hell? These indicators should be studied closely. When a stock is on a springboard, on the bull side, a stock is or market or group is on springboard following a period of preparation. This usually occurs at the bottom of a decline, or at the top of an advance, though it is also occurs after price has been in the trading range following consolidation of a previous advance, basically a pullback in preparation for new markup. Alright, so it can occur in different areas. The greater the decline, the more likely large operators will accumulate the stock and make it the basis for a bull campaign. Why? They're buying low. Preparation for a considerable rise usually requires several weeks or months, depending on how much the operator wishes to accumulate and how much he may have had from the sellers. As he adds more and more to his line, the floating supply of stock becomes less. Alright, so he's basically absorbing all the stock between certain levels, so then he can push it up easily. Wow. Floor traders and outside operators who work on stock market technique make inquiries before they buy a large quantity of stock, such as how much is offered next 5 points up. And while the specialists are not supposed to give out this information, it is often obtainable to them. Not to the public, and not to me and you. The day comes when large operators decide the market conditions are favorable and he is ready to let the price advance if it will, or advance it himself by purchasing more stock so as to complete his line. If he has completed his line, he will bid it up, and whatever he buys in the process he will sell on the bulges so as not to increase his line above the desired number of shares. Okay, now he's just talking about bull springboard. Basically, he wants to make sure he mopped up all the supply at that level. He's got it. He's absorbed it. It's in his pocket. This is very important. Of all the time to take a position, a stock, this is the best. By waiting for the cycle, this is being the springboard. Remember, he's saying the springboard is the best. It's not a spring. It's not an upthrust. It's not a halfway back. Okay? It's not based on any technical indicator reading. The best time, it's not a breakout. It's not a shakeout. When is the best time to take a position? It's when it's on a springboard. And I'm going to be covering many examples of that. I think I've covered like at least two in prior studies, but I'll keep on going over it. By waiting for a psychological moment, and this is also interesting. I don't understand why he says psychological moment. I guess it's a moment where you make a judgment, on whether all the indications are there, whether the supply has been mopped up, has been absorbed, the background, the tightening, the consolidation. Nearly every day, some stocks are on the springboard, ready for a sharp move up. Wow. So ideally, if you want to get rich, the idea comes to mind that all I have to do is look for stocks on a springboard every day. If they're there every day, can I trade them every day? But let's be real, like, to develop that type of ability is really the mark of a great trader, and it would pay handsomely if you're able to identify springboards. If they're there every day and you could see them every day, imagine the potential monetary consequences of being able to just get a few springboards a week. Not even on a day, just one a week would be awesome. or prepare for a plunge downward, which may be, I see this by the way almost every day, but it's on an intraday level. So those are small and some are counter trends, but to get them on a swing level, like for big moves, it's really going to be something. I'll give some examples of it. Here's an example of a springboard, and you'll see this market rallied, came down, climax, started moving sideways, tightened. This is an example of a springboard where basically you see the large volume here. They put it in a weak, in a strong technical position, okay, because the public, they're out. There's this transfer into strong hands. Starts moving sideways, tightens, and you see that the volume dissipates. The down red bars don't have any follow through, and then it starts forming these higher lows. Why is it forming the higher lows? Because there's no supply. Because why? They've mopped up that entire area. This is indicated. Where's the... See? It's indicated they mopped up all those. It went down, they got the volume. The secondary time it went down, they got more volume. Third time, no, not really. Fourth, there you go. There, you see how the volume is dissipating on the down bars? It's because there's nothing there left, and then it comes down to this small area because they mopped up that entire area, and then bang. So that's definitely a springboard. See another springboard? Oh shit, this right here, this is a base, but I'm not sure which is the springboard. This is actually a spring where they mop this area up. Let's see. There was a transfer into strong hands. There's a transfer into strong hands. There's a transfer into strong hands. Here there's a transfer. This one of these is springboard. This is where it's accelerated, and this was a psychological moment because this green bar, they're just buying everything under this level and then accelerating price. So this is like an extended base, but it was on a springboard. It just looks a little bit different from the higher lows. It actually has a spring. So where else is a springboard? I think this is springboard too. This right here goes down, down. You see the difficulty? There's actually more volume here than the bar before it, and the lack of progress in the closes. This is a transfer, and then let's see where this is. You see? And then they mopped up the entire area as indicated here. Look at this. You see what happens? It's even below the volume moving average line. See that? And then bang. So this is a springboard. That low volume is because they cleaned out the entire area. And then the tightening and the consolidation, 1, 2, 3, 4, 5, and then goes dip below, close above, and bang. There's actually a breakout there. Where else? I believe this is a springboard also. Right here on a pullback. Why? You got the high volume here. It transfers and then lower, 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 and then initiates. This one's not that clear. I really don't know about this one. Just forget that. This, I think, was some type of springboard here. So, because you can see the red volume after this bar, transfer, then it starts going down, 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 down. You see? And then right here is where they decided, okay, a lot of volume, we're ready to go. Transfer, because the volume has to transfer into strong hands. Anyway, where else is it? To some degree, this is also springboard. Let's see. So, it's more like a breakout. It's difficult to see it clearly here. And these tightening areas, look for springboards over there. This is accumulation. Anyway, back to the course. Where is the course? So it's on the bear side, you have springboards. In the case of distribution, this usually occurs at top of an advance, but it also occurs after the price has been in a range following a decline in which further distribution is taking place and new preparation is occurring. Some people regard a stock in this springboard position only when it breaks through an old line of resistance or support into higher or lower field. I claim that the beginning of the springboard is at the bottom of a range of accumulation or at the upper levels of a range of distribution. Yeah, that's true. That is true. Examples of springboard positions have already been given. I might go into every single one of these examples to clearly illustrate this, because if you can identify springboard positions and trade them, oh boy, if you can identify and trade springboard position, which is the original real recommendation from Wyckoff. Wyckoff didn't say, Evans said, springs and up thrusts as triggers. I understand, that's fine, it's great. But what is Wyckoff saying? Of all the times to take a position, this is the best. What does that mean? What is the trigger? What is the setup? What is the Wyckoff setup? The Wyckoff setup is the springboard. It's not halfway back or anything else. The Wyckoff, it's not a spring and it's not an upthrust, although those are great and they give great opportunities if you know what you're doing. But the Wyckoff recommendation and the Wyckoff setup that he said and recommended was the springboard. He says it was the best one out of all of them. I know halfway back is fine because you're selling on the bulge and all that. It's great. Springs are great also because they're tests that are fine, or retest, absorption, upthrust, test of upthrust, jump over the creek, test, etc., etc. Or just buying and selling right after the climaxes. But the recommendation of what is the best is the springboard. So the point here is study springboards. That's the point. So you can trade springboards. And he says that every day there's some stock on a springboard. So we'll see how to get them. I can identify them, and that's also not an easy thing to do, but I've just shown 2 or 3 things on how to do it, but it's a lot more to it. You have to have, I don't want to say a checklist, but you have to know that market, and because there's a lot of behaviors there and all that. Anyway, study of volume. Much can be derived from a study of the volume of stock bought and sold in the whole market, as well as groups of stocks and individual issues. This is a real pain in the ass today because all those goddamn groups, excuse my language, none of them are being updated in these charting platforms, and they have $3 stocks in them that are not leading and they're not active. So those groups suck, uh, and it's very hard to find leading active stocks. So I don't know. Maybe SMI might be might be might be what am I? What's the word? Might be identifying or doing all the filtering, because it's not easy chore to constantly have leading active groups. It's, and you don't want to spend all your time looking at different stocks to see if they're leading active and recalculating the group indexes. This is a chore that should be done mechanically, or let someone else do it. And I'm not really sure if SMI does it, or Todd Butterfield in his new software, which looks good. But I know that other online charting platforms like StockChart.com, those group indexes, I don't think they've been updated ever. So it's horrible. And if y'all know of where to find leading active groups that have a symbol that I can chart, then just please paste a comment on the videos, so it will help everyone, not just you and me, but help the Wyckoff community. Anyway, moving on. A small volume. A small volume that is little activity in a stock. So we talked about high volume, what it means, transfer of activity, transfer of inventory at the top and bottom, puts it in a weak or strong position, etc., etc. But what about small volume? What does small volume mean? It means that it is neglected by traders and the public. When this small volume occurs at the bottom of a considerable decline or at the top of a reaction or a dip, it usually indicates a lack of pressure. A lack of pressure at the bottom, on the pullback, a lack of pressure, a drying up of selling. Dullness may be introduced for the purpose of accumulation. Insiders may put out all their orders to see what the stock will do if left to itself. If they wish to buy, they take what is offered without bidding for it, never taking all there is, but always leaving some on the offered side to keep prices depressed. If 500 shares are offered at a certain price, they will take 200 or 300. To continue this process until they have acquired a substantial part of their line, after which they may begin to bid for all they can get up to a certain point, or until they see that they are attracting an outside following. Then they will withdraw their orders and let the stock sag and turn dull in order to deceive the public into thinking there's no further interest in it. Okay, a small volume may have a different meaning at the top of a rise or rally or small recovery. Okay, this frequently is a bearish sign. It indicates that demand has been filled or has dried up. The stock will probably go lower because demand is lessening and supply will overcome it. You see a low volume pullback thing, or low volume rally, which is also interesting there. There are exceptions to the above indications. However, thus a small volume and narrowing into small price movement after a rise may mean that the stock is resting and digesting its previous gains instead of reacting prior to a further advance. Therefore, in judging volume indications, we must be careful to take into account the action preceding a particular volume indication, as well as all other technical infusions, price and volume, etc., etc. What he's saying is you can't just say high volume is bullish and low volume is bearish. Low volume could be bullish and high volume could be bearish. It's a matter of judging the background. The background is what's going to tell you the meaning of the volume, and this is only gained through experience of seeing a lot of charts. Dull periods generally correspond to the end of a chapter in a book. This is very important too. Dull periods, end of a chapter in a book. Usually when you see hinges, they have dull periods, or even springboards, they have dull periods. An increase of volume of trading in usually very significant. When volume builds up fairly consistently on an advance, a further rise may be expected. On a decline, a tendency towards increasing volume or failure of volume to diminish materially usually forecasts lower prices. An unusual increase. Here's some important data. A sudden surge of volume generally indicates the culmination or approaching culmination of a movement. This is very important. So what does culmination mean? It means like all of a sudden you have one spike. So you have volume, could be low volume, could be moderate volume, but let's say price continues to go, and then bang, you have high volume that's sudden. That is the culmination of a movement. See buying and selling climax in 7M. You know how many times I've gone through this? 7M. Where bear markets generally terminate in narrow price movements to the accompaniment of low volume and listless trading, bull markets terminate in relatively wide price swings accompanied by high volume and more or less feverish activity. It is the change of dullness to activity, or the reverse, which is important, and a manner in which the change occurs. The change puts us on guard to watch for further indications which will either confirm or deny direction of the trend in which the change occurs. Suppose a stock were traded at the rate of 2,000 shares a day for many days within the range of 2 points. This would be merely a trader's market in the stock, but if it should break down through a former support line and the volume should increase to 3,000 or 4,000 a day, which would probably be 3 million to 4 million a day today, this would be a relatively large change, indicating an increase in the supply sufficient to overcome the proportionate small demand. The volume of stock warranted by buyers may not have shrunk, but the increase in quantity coming to market would be more than these buyers were able to absorb. So the price would decline, and effect of the declining of these conditions would induce more people to sell, thereby adding to the supply. If the stock advances 5 points in a transaction of approximately 60,000, it's very important too. It is not feasible to lay down fixed rules for volume. And it's also true for price. As a trader, you're really a detective, judging the psychological reactions of all buyers and sellers, weighing their motives. This is something that you see a lot of other people copy, but he said it first. Volume is gasoline to an automobile. Temporary increase in volume, not good, because it has a little bit of gas. It doesn't have enough gasoline. It doesn't have consistent gasoline. Again, he's making a point about a temporary increase, a sudden increase. Sudden increase volume is not good. A gradual increase in volume means that public is participating as price is going, and you can expect it to gain momentum because the gradual increase in price and volume is public participation. Pages is this? Alright, volume of individual stocks. Let's see, anything interesting here? Alright, so what he's saying here is that certain stocks has certain habits. You should know what those habits are. And that's only if you like observe that market for quite some time. Some stocks top out on heavy volume, others on light volume. You see? High-priced issues move more easily as a class than low-priced stocks for the above reason. The public is afraid of high-priced issues and doesn't like them anyway because it can't unload up with them. Let's go back to this one. Price versus quantity. The sponsorship of most low-priced stocks is passive or inert because these issues attract the largest following. And this is so because the public always thinks in terms of price because they want to load up on a lot of $1 stocks. Active management dislikes to move an issue in the face of a large following. They have nothing to gain by giving the public a free ride. The big fellows prefer to let outsiders in when it serves their purpose best, namely when they are actively marking up or distributing. If they see a chance for a good move, they'll find too much company in their stock, they will shake it out. Alright? Higher priced issues move more easily as a class than lower priced stocks for the above reasons. The public is afraid of high priced issues and doesn't like them anyway because it can't load up with them. Of course, experienced investors know that price alone is not a sound criteria of value. You're looking for a lot of other things, like what is the potential change in price. Let's see. I mean, what he's saying kind of makes sense, but at the same time, penny stocks, those types of stocks, where low float stocks, they go crazy. Um, so maybe that's just a different niche. What he's advocating here is high priced stocks, basically active leading stocks. That's what Wyckoff is. He's looking at tracking and he recommends. Alright, so we're done.